it's now been about a month since the American public took part in what could probably be called the world's largest IQ test, and in demonstrating the collective intelligence of their population, they elected the ginger groper as their president. As such, I thought it might be instructive to have a look at what markets have been doing since the election. And I want to start with a very, very narrow focus. I want to look specifically at the Dow within the context of its continuing bull run. And as you can see, the Dow had a little bit of a fill-up post the election and moved to an all-time new high. And you can see this within the context of the sweep of that wonderful bull market they've been enjoying ever since the end of the GFC. And to put this into some form of context to get some idea of how energetic their bull market has been, this is simply the value of $1 invested in the Dow at the low point of the GFC back in 2009. And you can see that you would have doubled your money just simply holding an index ETF. So it gives you some context of the scope of what's been happening with the US market over the past few years. The issue with this is it means that this is a very, very mature market. Their bull market has been going now for 7 and a bit years, which does, in terms of bull markets, make it a little bit long in the tooth. That doesn't mean that it's going to end. It could end tomorrow. It could go for another 7 years. The notion of predicting when these will end based upon the average length of previous bull markets is very, very much a fool's errand. But there are a few points we can make, a few observations. We can see that it's been 5 years now without a correction of 15% or more, which is unusual. That's not something we would expect to see within markets. Yep, there have been 2 minor drawdowns in recent memory, but if we look at this within the context of drawdowns, it's not unusual for markets, particularly the US market, to draw down 20-25% on a regular basis. You can see here the shocking drawdown that hit the market during the GFC, but since then the market's been relatively calm. There's been a few one-off shocks here and there. There's been a few times when people have dropped their bundle, but these have come to naught. And it's important to note that predictions of the end of a bull market are like any form of prediction. They're simply bullshit. People who make them have no idea. I have no idea. They have no idea. At least I'm grown up enough to admit that I have no idea what is going to happen with the market. And so we can only ever trade what we actually see. We can only ever participate in the market as it presents itself, as opposed to how we think it should present itself based upon an assumption of the past. And if we widen our focus to the S&P 500, and it's necessary to do this because US markets are dislocated a little bit. The broader your view becomes, the more obvious these dislocations become. The S&P 500 represents, in overall scope, a picture that's very, very similar to the Dow. But its fill-up post the election of Trump, what they're calling the Trump bump, has begun to falter in the past week or so. The broader market is not as convinced. And if we take a closer look, we can see a move to new all-time high, and then last week's slippage as the market began to pull back. The broader market in and of itself is not that convinced about what is actually occurring. And if we step back even further, we get a different perspective. This is the Russell 2000. You can see its large intra-week gain, one of the largest on record, immediately post the election. You can see a move to new highs, but then we have this large outside day or outside week where the market has begun to retrace. So again, we see things that are slightly different when we change our gaze. And this is one of the issues with traders. We become myopic. We simply look at the very, very narrow focus and think that the narrow focus is all that there is. When in actual fact, if you take a deep breath and you take a step back, you see things that are different. You get a different perspective. And this is important, as we'll see in a moment, when you're trading certain segments of a market. Because looking at the broader index might be completely irrelevant to the segment of the market you're trading. And you have to be aware of that and not be caught by that. But if we step out and look at our market, we see something very interesting. We see that the market continues to be mediocre and mundane. From the first quarter of the year, we had a small uplift. There was a nice little channel which, as seems to with our market, dies a natural death. And the reason for that will be obvious in a second. You can see we had a little bit of a spike reversal. Market lifted a little bit. Market's now, to use a technical term, died in the arse once again. And this is an annoying thing. This is very, very frustrating for stock pickers because we simply cannot get a decent run on with our market. And we find that because our market is composed of two segments and only two segments. We make the mistake of comparing our market to the US, and it's not. They are not comparable in any way, shape or form. The US market is broad, diverse and mature. As is a tin pot little shit box of a market most of the time that has two segments and two segments only. It has banking and finance, which is dominated by our four banks, and it has resources. And what I've done here is stack these two sectors one on top of the other over a reasonably long term. And you can see that there is a syncopation, a dislocation between the two. And this dislocation is important. You can see when one starts to slip, the other, through coincidence, and only through a coincidence, has a little bit of a fill-up and moves forward. What this has meant over the past few years is that our market hasn't collapsed completely, nor has it gone ahead in leaps and bounds. And to be honest, as stock traders, we want a speculative fervour. We actually want a bubble. And we want a bubble that is of the order of magnitude and size that is currently existing in property. That would make our jobs as stock traders so much easier. So when someone says that they want the market to move up cleanly and logically and sensibly with prices and valuations being in line, they clearly don't know anything about making money. What we actually want is, in our market in particular, given its small size, is to have a great deal of speculative fervour. Because remember, as speculators, we're not interested in the true secondary functions of the market. That's not something that we're interested in. We really couldn't care less that stock markets are a capital raising entity that enables businesses to raise capital to start businesses and expand. Nor do we care that it is a valuation matrix of some form or other. We just want prices to go insane. And because of the nature of the way we tend to view markets, we want the lower end of the market to go insane. We actually want the smaller end of our market, which by and large is most of the market. Our market, once you get outside the top 50, tends to struggle in size and quality. And in fact, when you look at stocks outside the ASX 300, most of them really should not be listed, but they are. And because they are listed, they do actually provide us with an opportunity. And that's what we actually need. We want our market to go bonkers because that's where most of our drive and most of our profit comes from. We've already had a bull market in the ASX top 20. And that bull market has passed from my observation. We now require some fill-up in the lower end of the market where the smaller price stocks actually begin to move. And what we really need to see are these two indices, the small ordinaries and the small resources, begin to move and move very, very strongly. As you can see, over the past 3, 4, 5 years, they've really done nothing. Now, granted, most of the small ordinaries is composed, well, I won't say most because that's wrong. A good proportion of the small ordinaries is composed of resource stocks. And yes, while base metals have been on again, off again of late, what we really need to see are the precious metals take off. We really need to see gold, silver, platinum, palladium take off, because these offer a great deal of speculative verve to our market. These are what gets the smaller stocks going, which gives us the capacity for outsized gain. And that's the thing we're looking for. And it's the thing we must always come back to, that in trading, what we want are outsized gains. This is the thing we look for. During the week, I attended a shares versus property debate where everyone was very polite. As you can tell, I wasn't necessarily that involved because everybody was very polite. And people were talking about constant growth, being able to pay off your borrowings, yada, 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 all the boring crap that people involved in property talk about, and the fact that none of them had bought property when it wasn't a bull market. So everyone's a genius then. What we as traders look for is none of that. We actually look for outliers. We look for the stocks that go from 10 cents to $2. That's what we want. Nothing else really matters. Which leads me to the salient point of this little chat. And that is that unless markets are running hard, it's really pointless to trade equities because it's too hard. Granted, there will always be opportunities. There's no denying that. But those opportunities that do present themselves are often quite rare, and the trajectory with which they present is often really quite bumpy and very, very annoying, and does tend to wear very, very thin. Conversely, and this is a very important point, when equities are running hard, it's pointless to trade other markets. When our domestic equity market is running hard, there's no point trading FX. There's no point trading commodities, simply because they don't enable you to take part in outsized gains. And this is where anyone who has traded the US market over the past 6-7 years has been really quite clever, because their market has offered these outsized gains because it is running hard. Here in Australia, because of the reasons I've outlined and the distortions caused in the economy by the housing bubble, we haven't enjoyed that. So we've had to look elsewhere and look at other markets. However, the point to note and the point to finish on, it's probably not going to be like that permanently. Markets markets repeat. Markets go up, markets go down, markets go sideways. But there is always, at some point or other, a new trend for us to take part in. There is always something new. And I think, in part, what we as equity speculators need to do is, in some way, unhitch ourselves from the nonsense that goes on in the world, particularly in the US, because that seems to be the capital of nonsense and idiocy, and simply concentrate on what opportunities present themselves, if any, in our market, and move on from that. And eventually precious metals will run. Eventually the small end of our market will take off. And in doing so, it will present itself as opportunity for us. But until that time occurs, you really, really, really must only ever trade what you see, not what you think you see, or even worse, what you want to see.